How can you tell if your employees or your customers are stealing from you? How do you know someone is not stealing your beer, cigarette, or other merchandise? Is your business losing money every day and you just don't know about it? Let's see how a great inventory management system can help you stop the leaks. Stay tuned.
Welcome to the one and only Gas Station Business 101 podcast, where you can learn all the secrets about how to start and operate a gas station business successfully and make money. This podcast is brought to you by the good folks at CSB Academy Publishing Company. And now, here is your host, Shabbir Hossain.
Welcome to Gas Station Business 101 podcast. I'm your host, Shabbir Hossain. And this is episode number 55. This is the show where we discuss how to start, run, and grow a gas station business successfully. And I show you the inside look of many real-life case studies so you can learn and apply that and win in your own business. Now, the topic today is how to have an effective inventory management system so you can pretty much monitor your store's inventory level and find out if there is any theft going on behind your back. Now, usually every retail has some degree of theft, and it could be by various people and various ways. And you can hardly ever stop 100% of this leak. And if you're trying to stop 100% of this leak, you may find out that that is very hard to do. In real world, yes, it is very hard to do. But in ideal world, yes, it is possible. But you may have to dedicate pretty much all your life staying inside the store and monitoring every transaction, which is usually not possible. So as long as you can minimize it, keep it under control, you will be doing okay. Most of the big corporations, from Walmart to everybody else, all the big corporations, they know there is a loss. They call it the system loss. And as long as that loss is within a acceptable range, they accept that. It could be mismanaging of the inventory. It could be inventory being broken and mishandled. Theft means somebody walked away with it. It could be the customers, could be the employees. So they know that there are certain degree of this mishandling, theft goes on in every store. But as long as they keep it under a certain percentage, they consider themselves lucky and they think they're doing great. And one important thing on that, always remember, as a business, whatever loss you have is usually a tax deductible expense. So let's say, for example, if one of your employee or your manager for that matter walks away with a weekend's deposit of, let's say, $15,000. It has happened to me once, years ago, that they opened the safe because they were the manager, they had the access to the safe, and they took the whole weekend's deposit, which was about $15,000, and just walked away, left town, and nowhere to be found. Now, what I did is I filed a police report, but the police were unsuccessful in finding that person. But what ended up happening is the insurance that we had at that time, I believe our deductible was about $2,500. So they took that deductible off of their balance and paid us the rest of the money. And at the end of the year, when we filed our income tax, we added that $2,500 deductible as an expense because it is an expense in your business because you lost something that you were not supposed to. As long as you were doing your best to protect your asset and then something like this happens, it is a tax deduction that you get. So a lot of the business think of it that as long as I lose 1% of my inventory, I can sustain that and take the tax deduction, so I will be okay at the end of the year. So that is one approach, but that's not what we're here today. That's not what I'm going to be talking about, how to get that tax deduction. Instead, My goal is we're a very small business, so we worry about tax later, but we need to make sure we're making money now. And how do we do that? We do that by having an effective inventory management system. Now, there are two ways people can steal from you. One is your cash, of course, and that is usually done by your employees. Your customers do not have access to your cash, but your employees do. So if somebody is taking money out of your register, that's a theft. But that's not what we will be talking about today, because I know I have addressed that in previous episodes where I talked about theft and how to manage cash and catch if some employees are taking cash out of your register, because it should balance. Your report should balance at the end of the night as far as how much cash came into the store versus how much he or she actually has in the safe. So that is, I would say, much easier to catch than anything else. If somebody is walking away with, say, a 12-pack of beer every night, how would you know that? How can you catch that? Your cash is balancing, so you're thinking everything is good. But if 1 or 2 or 3 or 4 or 5 cases are walking away every night, or every day for that matter, it's hard for you to catch unless you have a good inventory management control system. Now, I'm not talking about it. It may sound scary, but I'm not talking about a complicated computer program that will monitor your inventory. No, that's not what I'm talking about. I'm talking about a system that you can implement and follow through to see what's coming and what's going and how much of that inventory is left on hand. Now, let me get into the detail. Let's get into it so you can see what I'm talking about. But first, let me define what theft is and what kind of thefts there are in our business. And I know I've addressed this before, but I will say it again. There are 2 different types of theft that takes place in most retail. One is external theft, and the other one is internal theft. Now, external theft is usually done by people that are coming through your door and that are not your employees, your customers, your vendors, and those sorts of people that can pick up a candy bar or something smaller, put it in their pocket, or the vendor that brings you the merchandise can sometimes bring you, let's say they say that they brought in 50 cases of something and there is really 47 cases. And when they counted, you thought there were 50, but there were really only 47. So that's a theft done by your vendors. So these are your external theft. And then there are something called the internal theft. And internal theft is usually done by your employees because they're the one who are behind the counter. They're your employees. You hired them to look after your business, but in return, they're harming your business. And usually, if you ask any business owner, they will tell you that the internal theft is much harder to handle and control, and you lose more money than any external theft can cost you. So it's usually harder to catch, and you lose more with internal theft. Now, let's get into the inventory management or control system. Now, there are 2 ways to do this. One is called item level inventory, and the other one is called department level inventory. Okay, now let me explain each. But before that, let me tell you about some of the big corporations that we see around us. For example, the Walmart or your 7-Eleven, Circle K's, Wawa Food, and all of these national or regional chain stores, even most of the local chains that you see around you, most likely practice item level inventory. And as you can see, most of the gas station you walk in nowadays, including yours as well, I hope, that use something like a scanner. Anytime you bring something to the counter, they scan those merchandise and tell you how much you owe them. So that's part of the inventory management system. Now, as for the bigger corporation, what they do is they manage inventory with something called item level inventory. And essentially what item level inventory is that they track inventory by each item. Now, sounds confusing, I'm sure, but this is how they do it. For example, when a supply of grocery or beer or soda come through that door, the vendors that bringing those products, a manager will take a handheld scanner and go in, meet the vendor, and then scan those products. Let's say they brought in 100 cases of Coke 2 liter. So she will scan, or he will rather, whoever it is, will scan that 1 2 liter and enter the number 200 times 8, whatever that is, which is 1600 bottles, I believe, because each case has 8 of them. So essentially, she's letting the computer in her back office know that they just took in 1600 bottles of 2 liter Coke. And similarly, whatever else they brought in, they would scan each barcode and enter the number of those bottles or cans that they were buying. So the computer knows exactly how much inventory the store has. Let's say they already had 200 bottles of 2 liter Coke on hand when this 1600 bottles showed up. So the computer automatically would add 1600 with that 200 and say, on hand right now, I have 1800 bottles of Coke 2 liter. Now, a customer picks up a 2 liter bottle, goes to the register, the cashier scans that 2 liter bottle and sells that bottle. Automatically, the backroom computer would deduct that one bottle, and then anybody wants to see a report, let's say 5 seconds after this customer buys it, the report will tell the manager that in store right now they should have 1799 bottles of Coke 2 liter. And similarly with everything else, let's say Marlboro Light box, Marlboro Red box, or a candy bar, let's say a Three Musketeers candy bar, regular size. How many of those candy bars they have, the computer can pretty much specify a number that we should have 48 Three Musketeers regular on the shelf right now. Because see, whenever the grocery come in, they scan those in. But nowadays, things have gotten even easier. See, it used to be where a manager has to stand and meet each and every vendor and scan each and every item. But a lot of the big companies nowadays send that data electronically. And your employee would just come and match the product. If the invoice says that they have 200 cases of 2 liter bottles coming through the door, they just will make sure that there is 200 cases, or there are 200 cases rather, and not 199. Once they match what the invoice says that came through the door, then they're done. And the manager of the store then uploads that data. Instead of scanning anything, they receive that in an email or other form of FTP, where file transfer protocol. That file comes in and says, this is the Coke invoice. And they will just merge that with their inventory file. And inventory automatically uploads it. Similarly, if you have a grocery company like H.D. Hackney or McLean or whoever, they usually send you that data electronically. And as long as you're using a software that is compatible with their software, then these data will merge. Most of the big companies use software that are compatible with some of these big companies. And they're usually quite a bit expensive. And that's why a lot of the small business owners like ourselves, we manage it differently. But this is how the big guys do. The big boys, they have this thing called item level inventory. So anytime, let's say the manager of a 7-Eleven has a feeling that he or she is having problem with cigarettes. She thinks somebody is stealing a pack or two of their cigarettes. What they may do at that point is she or he may go to the back office, run a report of on-hand inventory of, let's say, 40 different kinds of cigarettes. And then she or he will simply come up front and match how much they have on hand versus what the report says. And so it can pinpoint that they're missing a specific brand and a pack type of cigarettes. For example, after the count, she may write a report that says they're missing Marlboro Light Box Short 7-packs. So they know exactly which brand, what pack, what SKU number, and what exact item number is missing from that store. And then they will try to find out how this theft is taking place. Then they may have to watch a video or do other things to find that thief and catch him in act or whatever they have to do. But at least they can identify this problem anytime they have a suspicion. But as a regular way of doing business, they always do their inventory at least once a month, and then they try to match it with their on-hand inventory via computer and see if these two are matching or coming close to it. This way they know they're not having serious amount of theft, because they all know that customers will come through the door and they will pocket some items here and there. Some customers will confuse the cashier and may walk away with a pack of cigarette extra and things like that. So it's not like everything runs perfectly in every store, regardless of what system they have. But as long as they know it is under a percentage of certain percentage that they can handle. Now, if instead of 7 packs, she sees that they're missing 700 packs, then that is a problem. That is a huge problem to handle. So time to time, they have a system where every week they have to count one department and match it with what the backroom inventory database tells them. And then they would have to write a variance report, what says, well, the computer said or the database said we should have this much candy, and we found we had this much. The variance is we're missing 7 Three Musketeers, 2 of these other candies, 3 of these Reese's candy bars, or whatever it is. They will write a report and say we're missing such and such candy, total price of, let's say, $70. And if that is within the acceptable range, they will not go any farther. But if it is not, then yes, they will try to investigate and find out who and how this inventory is coming up missing. Now, as for smaller businesses such as ours, we don't get to do this item level inventory. First thing is, we may not have that much manpower. Have an extra manager, have a person to handle that database, run the report, match inventory every week, unless you're dedicated to doing so. So what we end up doing is we practice something called department level inventory. And the problem with department level inventory is you cannot pinpoint exactly what item you're missing. You most likely will be able to tell that you're missing merchandise in a department, but not exactly what merchandise. For example, the department level inventory works in this way. Say you're starting out with a empty store today and you just brought in your first batch of inventory. So let's say you brought in $3,000 worth of beer. Now, a week later, you sold $2,000 worth of beer. And if you did not get any deliveries whatsoever in this 1 week, then you should have on hand $1,000 worth of beer inventory. Now, if you count that, let's say after closing on the 7th day, you count your beer inventory. And you see you have exactly $1,000 worth of beer. Then you're fine. That means you matched what you should have on hand matches what you actually have on hand. But that's not how simply this works usually. As you can imagine, we all have merchandise in the store and deliveries come every other day or twice a week, once a week, however way that works. So the way we do it is we count inventory once a month, every first of the month. There is usually a company, and some people do it by themselves, but we have a company that comes in, counts inventory by department. Now, since we're doing department level inventory, let's talk about these departments, the way most convenience stores and gas stations are set up. And I'm sure your station is set up that way as well. And I've talked many times about how these departments work, but let me just go ahead and say it once again, that typically most stores have product categories such as cigarettes would be one department, beer would be another department, tobacco would be another department, then soda and drinks would be one department, then grocery would be one department, then automotive should be another one, and then fountain drinks and coffee should go under one department, and then maybe novelty and few other departments that I haven't mentioned. Like if you have a deli, there would be a deli department. Some people have accessories department and various ways. I mean, stores can have 20, 30 departments, but we usually tend to go with this 7, 8, or 9, however many that these are. And also, one thing we look at is, since we're not doing item level inventory, and we understand that it is very hard to count every candy bar or every cookies and every crackers and every Motorola. So what we usually do is, from experience, I have seen and we have seen that mostly if you're having theft, it's typically the internal theft that we worry about more so than external. For example, customers will come, and not all of them, but maybe 1% of your customer will come and pickpocket a candy bar or other crackers or cookies, and those are very hard to catch, and that's not what we're after. What we're after, if there is a huge internal theft, or external for that matter. So we realized and seen over the years that typically people steal 2 or 3 departments at the most. First is always cigarettes, and then there is beer. And if they have to steal something, there are expensive novelties that some stores carry, like, for example, some energy shots that come in small bottles, and energy pills, or let's say some stores even sell cell phone accessories like Bluetooth and stuff like that. Those are like $20, $30 each. So these are expensive items. So what we do is we narrow down to at least 2, maybe at most 3 departments, and then we keep an eye on those departments. Even though the grocery is being counted all over the store every month, from grocery to Motorola to candy bars and everything else. So what we do is, at the end of every month, or beginning rather of every month, when the inventory is being counted, we sit down and we take a look at our own data entry and see how much we purchased in each department. For example, the way our data entry works, and I'm sure you've seen, if you've gone to my website, which is gasstationbusiness101.com, and gone on under resources, or if you've heard previous episodes where I talked about many stores where I shared some P&Ls and some sales, you've seen that we do mostly our data entry on Microsoft Excel. You can do it in various other formats, but usually somewhere you have to enter those sales. For example, if you are set up in these 7 or 8 departments, you need to categorize your sales for each day under each department. For example, let's say yesterday you sold $700 worth of cigarettes, $500 in beer, $300 in soda, $200 in tobacco, $150 in groceries, $50 in automotive, $70 in fountain and coffee, and so on and so forth. Then every day for the whole month, you enter this data, these sales numbers rather. So at the end of the month, you have a total. For example, month of October. Let's say you sold $30,000 worth of cigarettes. Now, in another page, you will carry over everything that you bought for that month. So let's say you bought cigarettes 5 times in that month. And each time, whatever cigarettes you brought in, you will enter that number, that dollar figure, which is, let's say you sold $30,000 worth of cigarettes, but you bought $24,000 worth of cigarettes. Now, you may get confused because one number is with profit, which is the sales number, has your profit built into it. But the purchase dollars do not have that profit built into it. So there always is a difference. But the way that there are a few ways to do it, but the way we do it, I will say that first, is we look at our purchase versus sales, and then we look at our on-hand inventory. And this is how we do it. Let's say month of September, whatever we did month of September, October 1st, we had an inventory done. And let's say on hand, we had $7,000 worth of cigarette for that month. And again, in November 1st, we again did the inventory. The company came and did the inventory, and it showed we have $8,000 worth of cigarette on hand. That means inventory pretty much remained the same. Now, inventory will vary. One month you will see you have $7,000 worth of cigarette. Another month you may see you have $12,000 worth of cigarette. It always varies because it depends on the day your supply comes in. Your cigarette supply shows up in your store. Let's say it is every Thursday and the beginning of the month falls on Friday. So when the inventory people will show up, they will see or they will count the new inventory that showed up the previous day. So your inventory number will jump up higher, but no reason to panic for that reason. Only thing you're looking at is whatever you bought, did you sell more than what you bought? And the way we do it is we look at our sales, as I said, and purchases. Now, if we know by calculating each pack of Marlboro or each pack of other L&M or whatever cigarettes we sell, that our profit margin is, let's say, 15% on cigarettes. And I've talked about this in many episodes where we exactly know how much profit margin we do in each category. So if we know that our profit margin is 15% on cigarettes, then if we bought, let's say, $20,000 worth of cigarette, then how much is our profit for that $20,000? For simple calculation, let's say we bought $20,000 worth of cigarettes, and at 15% margin, our profit dollar, or penny profit they call it, should be $3,000. So ideally, if inventory remained the same, then I should be able to add the cost of inventory, cost of goods sold in this case, which is $20,000 worth of cigarettes, and add my profit, which is $3,000. And I should be able to match what I sold, which is $30,000 in this case. So you see, it didn't match. If I bought $20,000 and sold $30,000, then somebody didn't steal from me. Instead, there is a huge discrepancy, but in the opposite way, meaning I have more cigarettes than I should have, or I sold more than I should have. So in this case, either my profit margin is wrong or somebody brought in more cigarettes than I know of, which usually doesn't happen in any convenience store. You usually fall short, not over. But just to give you an example, this is how we calculate each department. Similarly, let's say we bought $10,000 worth of beer in month of October, and we sold $14,000 worth of beer. So ideally, if our profit margin is 25% in beer, then I should have made $2,500 by selling that $10,000 worth of beer. And did I do that? So in order to know, you need to add your purchase with your profit margin, which is 25%, which is $2,500 in this case, should have been $12,500. And if you see that you sold $14,000 worth of beer, then you have some excess beer. There could be other reasons for it. For example, that your delivery people didn't show up one time and you used up your on-hand inventory. In that case, your inventory will shrink from previous month to this month. So if that's the case, let's say you started off with $15,000 worth of beer on hand. Now you only have $12,000 worth of beer. So you shrunk your inventory by $3,000 or $4,000 in this case. And if you see that one of the delivery didn't come previous month, and you still sold $14,000 to it, then you know why. So that's how we match our inventory. But on cigarettes, we do something little bit different because cigarette, as I said, it's the lowest profit margin item with the highest cost. So we don't simply rely on the inventory and try to match how much our profit margin is versus how much we bought and how much we sold, because that gives us a vague picture, not very accurate. But when it comes to beer or any other merchandise category, that is how we do it. We look at how much we bought versus how much we sold, and if our inventory level stays the same, then our profit margin should add to our cost and equal to our sales. That is how simple that is. But for cigarettes, we do things a little bit differently. What we do is we count cigarettes in every shift. So we can make somebody or some cashier responsible if there is a pack missing. And the simple way we do it is At the start of the shift, our cashiers are supposed to count every pack of cigarettes. And there is a shift report that they work on, and there is a place for it that says beginning count. So let's say the cashier starts off with 1,000 packs of cigarettes. At the end of the shift, when she or he runs their shift report, they will go count the cigarettes once again. And if they come up with, let's say, 900 packs of cigarettes, that means in his or her shift, they sold 100 packs of cigarettes. And then what they have to do is they have to go to the shift report. And the shift report usually has all the department cells. And if you recall our episode where I talked about the cash register reports, I showed you some snapshot of cash register reports and the departments. And if you look at that snapshot, you will see that there are departments along with the sales figure and count. Means, let's say she sold 100 packs of cigarette. It should have a dollar figure next to it, which is, let's say, $575 of the cigarette were sold. And how many packs were sold, it also says that. It says count. Count is how many quantity was sold for that dollar amount. So once the cashier is preparing her report, he or she will write down how much cigarette they counted. So let's say he or she writes down 900 packs, ending count. There is a place for beginning count and an ending count. And then there is something called how many packs were sold. And she writes 100 packs. Then next line it says cash register report count. And then from there she looks at her cash register report and writes 100 packs. And then difference is 0. Now if she wrote 100 and she found the cash register said 98, then she was short by 2 packs. That means there are packs missing, and that is a problem. So this is how we do it. And then there could be error, but any error that happens in one shift should rectify the next one, because not 2 people count separately will make the same mistake. So the second cashier comes in right behind this person. They count their cigarettes and they write 900 packs. But for example, what if they write 898 packs? That means they found 898 packs and the other cashier found 900 packs. That means there is a problem with that cashier because she or he came up 2 pack missing, and then also she miscounted. Now, is this on purpose? Only way you can tell is once you see this type of behavior, you can follow that person for at least 2 or 3 shifts and monitor their paperwork. You will know if there is a trend of behavior or if it was just one-time thing. You see, as I said, if one person makes a mistake, the second person should rectify it. But what if the second cashier comes behind her, finds 902 packs? That means this previous person was making an honest mistake. And there was no 2 pack missing because it was on the shelf. So that's how you can tell who's doing something wrong and who is not. And this is how we manage our inventory. So if you go on to my show note for this episode, which is episode 55, I will post a picture of a cigarette rack with numbers. See, the way we count cigarettes is there is a method to this madness. And the way we do it is, as you know, every gas station you go has a rack right behind the cashier where there are all the cigarettes. It could be a Marlboro rack or Philip Morris rack and a R.J. Reynolds rack. And there is a layout for each store that there should be Marlboro light box here, red box here, 100 red here, and so on and so forth. And what we do is we number each rack from top to bottom. We start from the top, number 1 rack, number 2 rack, number 3 rack, number 4 rack, and then go to the next set of racks and say number 5, 6, 7, 8, and then go to the next set of racks and go on to, let's say, 25 racks. And then we keep cartons in some other places. So then at the end of these, there is a place for cartons. So all they have to do is we usually create a cigarette count sheet. Very simple. Just draw some lines with numbers that says rack number 1, rack number 2, rack number 3, so on and so forth, all the way to rack number 23, if that's how many you have. And right underneath it says carton count times 10, because we count every carton as 10 pack. So at the end of that, we have a total pack count for in shift and out shift, means they will come in, count it, and at the end they will count it again. So if there is any discrepancy between the two registers, between the two cashiers, a manager can pinpoint where the miscount has taken place by going through each rack. Let's say the end count of first shift should match the beginning count of second shift. And let's say there is a discrepancy of 2 packs. Then the manager can see rack number 1, she counted 23 packs, this guy counted 23. Rack number 2, this lady counted 30 packs, the guy counted 32. That means there is a difference of 2 packs right here. It's easier to catch somebody, or at least find out where the confusion or error is. So that's how we count cigarettes, because as I said, it is the most expensive item in a store. So we keep in pretty much like an item level inventory type situation. Instead of keeping it in the computer, we have our cashiers count all of the cigarettes and match it with their cash register report, so we know exactly how many packs were sold and if we got paid for those 100 packs or however many packs we sold. And this way you keep honest people honest. Now there is another way some people, I've seen some retailers do, which is they do their bookkeeping on a retail level. It is still a department level inventory method, but instead of, let's say, remember as I said, when we do data entry, we enter all our sales by department. Then at the end of the month, it tallies up all the sales. For example, we can look at a report that says, month of October, we sold $30,000 worth of cigarettes, we sold $15,000 worth of beer, $11,000 worth of soda, $1,000 worth of motor oil, and so on and so forth. And then the second page will have all the purchase by same departments. And in that page, we can see, okay, we bought $24,000 worth of cigarettes, $12,000 worth of soda, $15,000 worth of beer, and all of that, right? But as I said, remember, the purchase figures are pre-profit and sales figure are post-profit, means the sales figure has our profit built into it. Now, a lot of people, I've seen a lot of retailers, what they do is when they're entering those numbers, those purchase dollar figures into their system, what they do is they retail the inventory first and then they enter. So at any given moment, they can match it instead of adding profit margin and whatnot. A lot of people don't want to do profit margin. They just want to retail out their inventory. The way this one works is, let's say you have a delivery from Coca-Cola and the Coca-Cola people brings you $1,000 delivery. In that $1,000 delivery, there are cases of 2 liters, there are cases of 20 ounces of Coke, and there are some canned Coke as well. So we know all 20 ounce usually are same price, all 2 liters are the same price, and all canned Coke are the same price. Even though 3 different price tiers and 3 different pricing, but same price for, let's say, a can of Coke versus a can of Sprite. And same price for 20 ounce Coke versus 20 ounce Sprite. So what these people do is when they look at their invoice, they handwrite the actual retail value of that invoice. So for example, looking at that breakdown of an invoice in Coke, from Coke, we see that we bought $200 worth of 2 liter from Coke. Now, if we see that we paid 87 cents for each 2 liter, but we sell them at 99 cents, then we take the difference and multiply it with that quantity and get our retail dollars. Similarly, let's say we bought 100 cases of 20 ounce bottles. And we know that we pay, for example, $1 for each bottle. And we sell them for $1.39. So we're making 39 cents on each bottle, right? So we just need to count how many bottles we bought. For example, each case has 24 Coke. And if we bought 100, that's 3,400 Coke bottles we bought. So we just need to multiply 39 cents to that 3,400 bottles of Coke, and that should be our retail dollar amount for that invoice. So once we retail out each 3 or 4 or 5 or 6 categories, then instead of writing, like in my case, I would write, I bought $1,000 worth of Coke from Coke, and I will put it under soda drinks category. But the other people that follow this method, they will, instead of putting $1,000, they will retail it out. And let's say it retailed out for $1,347. So they will write $1,347. This way, they already retail the invoice. So at the end of the month, they don't have to figure out, okay, I make 15% on cigarettes, and 35% on soda. So I need to take my purchase dollar figure and multiply it by 35% and see if that matches the sales figure. See, this method is even better because in our method, we are estimating that it is 35%. It could be 33, it could be 36, depending on what you sell the most. As we all know, 2-liter Cokes and canned Cokes, we make least amount of money when we sell them as 12-pack or 2 liters. And we make the most money on 20-ounce bottles. Now, if a store sells a lot of 2 liters and very little of 20-ounce, then that theory that we said, 35% average profit margin on soda and drinks, will not apply to that store. But the people that are following this method, which is they're retailing out their invoice, should be very close to matching their sales figures because they exactly know what they bought and how much they paid and how much money they were supposed to make. So because they're retailing it out. So at the end of the month, their inventory should match, like I bought $27,000 worth of beer and I sold $27,300 worth of beer. So it can come very close, provided the inventory level beginning and ending remains the same. If not, you just have to calculate that, take something from this end and add it to the other side. But as I said, provided inventory level remains the same, if you retail out your invoice, then your inventory level should match perfectly if you are retailing your invoices. But if you're doing what we do, as long as you know how your store sales are, what you sells the most, and you know your profit margin by heart, you should be able to do it closely. And you may ask, why don't I practice that in our store? Well, we're lazy, I think, because it has to have a manager or some type of person spending a couple of hours every day retailing out every invoice. And usually I have my managers work behind the counter quite a few hours, so they don't have as much time as, let's say, 4 hours a day or 3 hours a day just to sit on a desk and retail out each invoice. And I'm usually good at calculating my profit margin by stores, so I know how much it should be. But if you're more comfortable in spending time figuring out how much each invoice retails out for, I think you will do yourself a favor and it will take a lot of guesswork out of your equation. So think about that. Well, we're pretty much at the end of this episode. So if you have any question about inventory management system, like I said, we're doing the very old-fashioned way. We're not making some complicated computer programs or installing a mega software just like big companies do and then having somebody to manage and monitor all of that. But you can. Cost of technology goes down over time. So I know that those softwares are going to be available at a much lower cost, maybe within next year or so. And there are a few other companies that are already providing services such as that. But trick is to find out if your local vendors comply or uses the same type of filing or computer file that can talk to each other with your system. If not, you can maybe install a good system, but then your grocery company's files are not matching up with this software. Your Coca-Cola invoice is not electronically transferred to this software. Then you're doing everything manually with a handheld scanner. You're standing in front of your door and just scanning every inventory that comes through the door, which you can spend 8 hours a day doing so. So before you invest the money, do a little bit of research and find out which companies, let's say you have a grocery company, ask them how can they send you an electronic invoice and what are those invoices compatible with? What type of software are they compatible with? So once they tell you, investigate, call them up, talk to them, ask them to see a demo, and if you are willing to invest that time and money, do so because you will sleep better at night. But until then, follow this procedure. Make sure you count your cigarettes in every shift and follow through every morning. Sit down and take a look at all the shift reports and see if there are any discrepancies as far as cigarette count. Because as I tell you, the most money you can lose in a gas station is from cigarette theft, because that is the most expensive, easy to hide, and they don't weigh much. So you can walk away with 5 cartons of cigarette, which is about $300, and not be carrying a huge bag. It can be a small bag full of 5 cartons of cigarette, but it will not weigh much, and it's hard to notice because they're smaller items and they're very easy to conceal. Okay, if you have any question, as I said, about this episode or anything about inventory or any other question related to gas station business, feel free to email me at shabir@gasstationbusiness101.com, or you can post a question on my Facebook group, and you can do so by going to shabbirhossain.net. This is the domain redirect to my Facebook group, because I don't remember, it's a long name. So what I did is I bought a domain and have it directed towards my Facebook group. Don't forget to sign up for my newsletter. And as I said in previous episode, we're almost to the final point where the migration is pretty much done. So you will be able to start receiving the email sequence that I've promised. And it will start very soon, I promise. But if you haven't signed up for my email subscribing system, you should do so by going to gasstationbusiness101.com/subscribe. Or you can go simply to my site and scroll down to the bottom, and you will see where it says, please subscribe to the email newsletter. In the meantime, if you haven't subscribed to this podcast that you're listening to, feel free to do so. You can, wherever you download this from, iTunes, Stitcher, Blueberry, wherever, just hit subscribe button. That way, whenever I publish a new episode, it will directly be delivered to your inbox. You don't have to look for it. It will be there for you to listen to. Lastly, I have decided to include a link on my show notes. So if you are going to my site to listen to this episode, and if you're looking at the show note, scroll down to the bottom and you will see a link to iTunes page for our podcast. So any of you are wondering how to give me a review on iTunes, which I would love to see from you, all you have to do is go to the show note and click on that link. It will take you to the iTunes page where you can subscribe or not subscribe, but you can always give me a review. So just look for that link. I don't want to read the link out because it's a long link, and you will see it says iTunes, apple.com/whatever. Just click on that link and it will take you to iTunes page. Thank you once again for joining me in this episode, and I will see you in the next one. Take care.
This has been the one and only Gas Station Business 101 podcast with your host, Shabbir Hossain. This podcast was brought to you by CSB Academy Publishing Company. Be sure to join us next time as we share with you the secrets about how to start and operate a gas station business successfully and make money.